All right, guys, welcome back. Today I will be taking you through the selected rules that guide my trading psychology and my operations in the marketplace. So these are rules that have really helped a lot of traders. They've also helped my trading. And I believe sharing this and you using this would really affect your trading positively. So these are rules that I have used over time, and I felt knowing smart money concepts isn't enough. Um, Having smart money concepts or having the knowledge of smart money concepts isn't the final or the holy grail to profitability. I don't think so. But there are rules, there are sets of rules that should guide your trading, even if you use smart money concepts or you use any other type of trading strategy or methodology. So these are rules that help you operate like a business and helps you operate optimize your performance. So we're going to get to it now, and I'm going to work you through some of my rules that I work with, and you may have seen some of them. And but now we have a complete or a more concise methodology, rules guiding my operations. And the very first one for me would be analyzing at least 20 days worth of data before each day's operation. So if I'm going to operate on Monday or this week, I make sure to analyze 20 days worth of data and at least 20 days. But I go as far as 3-4 months worth of market data before my operations any day. So you shouldn't, you may have heard me talk about this on multiple occasions. I don't like to jump into a or an asset class on the 15-minute time frame, and just to look at that, you would be blind, you would be blindsided. So as an intraday operator, one of the key things to do before each day's operation should be to analyze at least 20 to 40 days worth of market data on any given pair or asset class before going into the day's operation. That's just basic. So if the most recent day's data meets your criteria as you recognize the intention to price, then and only then should you think it right to operate the market or operate the marketplace, operate in the marketplace during that particular day. So if you understand, if you recognize the price pattern or what price looks like it's going to do over the next 2 days, over the next 3 days, you must anticipate that from price action over the last 3 months or over the last 20 days, at least 20 days. That's the list that you want to work with. So you're starting from a daily time frame or the 4-hour time frame as an intraday operator. So basically, what I'm talking about is the very first rule guiding your operation in the market on a daily basis should be analyzing at least 20 days worth of data. This is a religion. Okay, so you really want to follow this like a religion, and analyzing at least 20 days worth of data before operating in the marketplace for any given day. You need that understanding. Now, if you look carefully, you see I have the euro dollar. The purpose of this particular presentation is not to take you through technicals, but just if I talk about analyzing the market data for 20 days, then I must give examples. So now we have the euro dollar here, my favorite pair or my favorite asset class. Now, the euro dollar right here, as you can see, I have over 6 months worth of data that I look at. And if you look very clearly, you'd see that I understand, or that gives me a clearer view, a long time frame view of what to expect for the dollar. Now, in as much as you are operating within maybe just your operation would be perhaps around 2 hours long, depending on what the market is doing during that day. You need hours of preparation. You need hours. You need to look at data. You need to look at a very large sample size of data, because what you are doing lasts perhaps less than an hour, or even uh, an hour, but you are going to need a sample size of data, a large sample size of data, to help you decide what to expect for that day. Now, if you look here, you understand that I'm looking at a demand zone that has already been affected and price traded higher, took out this high. And you know the drill. We already talked about this, and we took advantage of this particular drawdown or drawback in price this past week. We took advantage of that, and we were able to capture a few good trades for the week and ending the week really good. Now, understanding that price would run in here and take off, this is something that I have to give to an analysis of 20 days, 30 days, 40 days. I need to look at price. I need to understand what it's doing before operating for a particular day. So that's the very first one. And the very second thing on your list, you really want to write this down if you can. You really want to put it down so you can see it on a daily basis. You really want to get comfortable with losses. It's okay. It's fine. And it's not something you can avoid. You will lose sometimes. So you need to understand that. This particular topic cannot be overemphasized, because losses are a major part of the trading business. So what we can try to do instead would be to manage or decide what equity percentage should be given to the market in the case where we are upside or in the wrong side of the price movement. So we can decide what percentage equity or equity percentage should be given to the market, which perhaps most times 1%, 0.5%, depending on your risk appetite. As you know, even the most profitable traders will lose money. But the difference between them, or the difference between the most profitable traders or the most professional traders out there and the newbie, is the fact that they maximize on their winning trades. They maximize on their winning trades management, and to cover up for their losses, and they always close out with decent percentage gain. So you will lose money. I'm not going to say you will always lose money, but you will lose money. But at the end of the day, or at the end of the week, you really want to look at your previous week's data or results, and find out that, well, my losses were covered for, and I came out with 2% account gain. Losses are a part of the business. It's part of the cost of doing this business. So you will encounter them. So there's no running away from it. You must prepare yourself to get okay, to familiarize yourself and be comfortable with them. When they come, accept them, but they must be within certain decisions, or they must be within already planned arrangement. I'm only going to lose 1% in this particular trade, or I'm going to give out 0.5% in a particular trade. And when that happens, I'm okay and I walk away. So they must be pre-planned and contrived. You always have to be in control of your losses. You always have to. That's the only thing. Get comfortable with the losses, but always be in control of the losses. Don't lose way too much than you ever planned for. So if you operate whatever size, whatever equity size, and it's not a short trade, or you feel like, well, this is a two-way thing. I could either make money or I could lose money. What you lose should be contrived. It should be pre-planned. It should be according to your decision, and it should not be open to the market to decide. So basically, I'm indirectly throwing more importance on using stops. Okay, so I can talk about using stops, but that's what it means. So you need to note that you cannot avoid losses, but you can mitigate them with your subsequent trades and your the trades that you use to cover these up. It's okay to take a loss. It's very okay. These are the rules that I work with on a daily basis. It's okay to take a loss and avoid subsequent executions after losing trade for the day. So let's say your major position for the day was a short position or a long position on the euro dollar, and you marked your charts and you highlighted everything that you needed to do, and you got stopped out for whatever reason. Take the L and move on. It's okay. It's 1%, it's 0.5%. And each of these trades are set up in such a way that you most likely or only lose 0.5%. But if you come back and max out your winnings on the next day, you could get 3%. That covers your 0.5% or your 1%. And so you make an extra 2% equity gain. So it's okay to lose in the market. It's okay. Get comfortable with it. It's okay. So that's the second one. And you want to get comfortable with using stops of 10 to 15 pips or even 20 pips if you identify that's the market environment within which you consider to be safe. I may be, or you may have heard me talk about using 5 pip stop, and I will get to that. And I will talk about that and throw more light to that. But you really want to get comfortable with using stops around 10 to 15 pips. I've seen a lot of times, I've seen traders who are looking for 4 pips stop without really understanding how to put up those type of stops. So I consider this to be the utmost importance, as your protective stop could well be the major determinant to whether or not you stay or get kicked off a particular trade, irrespective of you being right or wrong about the direction of price. So irrespective of your decision, or irrespective of your direction or how right or wrong you are, your stop is the most determining factor deciding whether you would get kicked off a trade or not. So every trader has that bad experience, including me, of getting stopped out only to have price move back in the intended direction. So you put a stop loss of maybe 5 or 6 pips, and you get stopped out, only for price to move in your original direction. You see, this is one of the biggest issues that we are here to mitigate. That's one of the biggest things that I've been trying to develop strategies or develop extra layers of confirmation that could actually help you or increase your chances of using very low protective stops or very small stop losses to really maximize on your potential winning. So the idea of 5 pip stops is, I'm a supporter and I'm a practitioner of. It's very attractive, but it can really hurt you if you do not understand what I call lower time frame refinement, or what is known as lower time frame refinement. And even if you do, it still isn't a 100% proof. As you know, you could still get stopped out occasionally because before the original move you are anticipating. So even if you understand the lower time frame refinement, you need to understand it's not 100%. It's not 100% proof. It could be 80%. It could be 70%, just depending on your bias, how correct you are, or how in line with the market movement that you find yourself in. So this is the reason why we use the higher time frame, lower time frame price mirror confirmation. And I will explain what that means. You already know what that means. So this is the reason why we use the higher time frame, lower time frame price mirror confirmation to add a layer of precision and certainty to our 5 pip type of protective stops. Okay, but in the case where you have to use 10 pips stop. Maybe because that particular asset class or that particular pair that you're trading is very volatile, and you need to use 5 to 10 pips stop, and you are not comfortable with it. You need to get comfortable with it. And one of the reasons why you are not comfortable with it is because of something called greed. You really want to use or maximize on every trade by using really large lot size. You really want to leverage on every trade by using very large lot size. And so you just want to make it really little. Now, that's a really huge pitfall to using 5 pip stop. And I will explain. The fact that you really want to leverage on every trade and use large lots on each trade, it would really get you hurt. You need to understand the market environment. You really need to understand where it's safe for your stops to rest. And you cannot do this if you don't get comfortable with using stops of 10 to 15 pips. At least for the start, you need to get comfortable with 10 to 15 pips worth of stops. And then when you start to understand more and see areas where price won't go, or it's very unlikely for price to reach, then perhaps you can really improve that and reduce your stops. But then for now, starting out, you need to get comfortable with the 10 to 15 pip stops. And I will explain with some examples. Now, I want you to look at this. This is the pound dollar. Okay, like I said, in order for me to explain very well what I'm talking about, you need to look at a few examples here and there. So we're going to look at this on 3 different time frames and see how you can actually use these stops and how you can use the 5 pip type of stops. Now, if you look at this on the 30-minute time frame, you can see the price traded higher. It took out these highs, and it pointed at the fact that we're going to get a rally to the previous day's high, or the last interest area for the previous days. So as you can see, this is a low. It got rated, and this forms what we want to call a pattern for a mitigation. Okay, so a mitigation, we would most likely mark this area and use that for our entry. But the question is, how far do you think, if you use the 30-minute time frame without refining, you would be entering here at this particular area, and your stop would rest just around here because you don't expect price to take out the low, and that would be around a 21 pip stop. You would be using around a 20 to 21 pip stop. That is if you don't understand. But I want you to look at this before we refine this further to get the type of stop that we're all looking for. The higher time frame, lower time frame, price mirror confirmation. Before we do that, there's absolutely nothing wrong if you used this area for your entry and you had a 15 to 20 pip type of stop. It gives you rest of mind. The only thing is you would have to reduce your risk by reducing your lot size. So now there's absolutely nothing wrong with that. There are times when there's absolutely nothing you can do but use 15 pip worth of stop on your position. Now, in this case, we have options. We could use that 21 pip or even 15 pip because we do not expect price to trade below this low, or to even trade to this area. We could do that, or what we could do would be to move to a lower time frame to take this further. That's another way we could do this. So let's assume that, oh, I'm sorry. Okay, so if we moved to the 15-minute time frame, or if we refine further, you'd find out we have more options that we could work with, and we have more reason to take a lower type of stop, perhaps a 5 or 6 pip stop. Now, that area, if we look at this particular swing low all the way to the top, you'd find that this was the reason for, this was a start of that move all the way up. And so you know what this is? That's a demand right there. It got validated. Now it got validated. We would have used the low right at this particular area as an area for our stop, or we could actually go further, and that would be a 6.4 stop. Now, this is the refinement that I talked about, and this is the higher time frame, lower time frame price mirror confirmation that we want to look for. Now, if we could still take this further and get a much lower type of stop, a tight stop or a tighter stop to work with. Now, we would look for the higher time frame, lower time frame price mirror confirmation, like I said. Now, go to the, now I want you to pay attention to what happened in here, the 30-minute time frame, the 15-minute time frame, and back to the 5-minute time frame. Now, this would have been the 15-minute time frame entry, but here on the 5-minute time frame, we had the same behavior right here. If we go back to the 15-minute time frame, it was the same type of behavior. There's a break of structure. Now on the 5-minute time frame, price moved all the way up. This was the start of that area. Or you could have used this area, but this was the start, and price traded back in there. Your stop would have just rested below that, or just right there, and price would not trade to that area. So that would have been a 5.9 pip stop, and to target the top. So basically, you need to put in effort to get the lower, the tightest stop. But until then, there are times when you need to get comfortable with the 10 pip stop. I'm going to give you an example. If you need to take the very first position, as we do, and you really need to, you're testing out that position, you want a tighter stop. The case where the very first area does not give you an opportunity to take a tighter stop, so you have to make do with 10 pip stop. Of course, you would reduce, if you were to use a 5 standard lot on that trade, you would reduce that to perhaps maybe 1 standard lot and wait for the lower time frame, just like we did here, to give you a confirmation so you can have a much lower, tighter stop to work with. And then you could come in there and putting the last 4 standard lots of your remaining position with a 5 pip or less, a 5 pip stop. And this is how you could actually do that. But until then, get comfortable with 10 pips. Get comfortable with getting on the very first trade. Even if you were going to do it with a 5 standard lot, 10 pip stop, get comfortable with that. Get comfortable with that as long as you are in the right, or in the you are well aligned with price movement for the day. So you really want to get comfortable with that. These are some of the rules that would really help you. And the next would be 25 to 30 pips daily and 60 to 80 pips weekly. Now, this is very easy. It is easy. It gives you peace of mind, and you don't have to hold for weeks. I understand that some folks have jobs and other duties, and it could affect their availability to look at charts every now and then, and that's understood. But for me, and for a lot of other traders who do this full time, and you may have funding from maybe some of these services out there and the prop firms that we now have all over the place, this is the best way to pass a challenge. This is the best way to stay funded. This is the best way to have peace of mind and get that cash flow, because at the end of the day, we do this for the purpose of cash flow. You want to get cash flow. so you could actually put somewhere else. I mean, that's another topic for another day, but that's one of the reasons for day trading. And there's no limit to what you can do here. 20 pips could be $10,000. 20 pips could be $20,000. Yes. And 60 pips could be even $50,000, depending on what you do with it. So if you intend to last as a day trader while operating with peace of mind, then you must satisfy yourself with 25 to 30 pips daily in your operations. Now, this is the reason why you always, or you will always find me satisfied or taking partials after 25 or 30 pips. I'm not looking for, you could tell where price, now you could tell the area where price would get to move from. We've studied and we've done a whole lot of work on that, identifying with precision our entries. But the truth is, you don't know where the windfall stops. You can't tell. You could identify the last impulse area, or where the last impulse started from, and the reference points that are around that area, such as say your demand zones and all of that. But there's no certainty that it would target and close those areas. That's what it should do, but you don't have certainty. But the fact that you're putting all this work, you should pay yourself. You should reward yourself for the effort. Being able, taking a trade and having that release, and only to find out that you get closed back with break even or on break even without any profit should be one of the most annoying things in trading. So you should be willing to absorb partial volume from your trades at 25 to 30 pips release in your direction, while keeping an eye at reference points around the previous trading session, day, weeks, low, or high, depending on the asset or pair. But there is no such certainty that you will have those areas traded to. There is no such certainty, but that's what the market should do. That's what we expect price to do. So in keeping with this, it means that you may not take or engage the marketplace every other day. No, you won't. It's very easy if you have found price to move in a particular direction, and at the time of the day, and you get 20 to 30 pip, 20 to 30 pips worth of movement in your direction. You really want to close out a partial, something that you would be satisfied with, and know that, well, if it moves against me, at least I closed with profit. I've had situations with traders where we were on a trade and we had price moving in our direction, and I told this trader, you might want to close half of your position, and he's like, no, I wanted to get to that level. And I sometimes laugh, because how can you be sure that it would get to that level? There is no certainty as to where it will get to. We expect it to, but we don't know. So 2 to 3 good trade runs with reasonable volume size sets you up for the week. That's my belief, and that should be your pattern every other week. If you intend to operate on intraday basis. There's an error on my write-up, but yeah. So if you intend to operate on an intraday basis, you should take that and walk away. So the next thing is trade for the money. It's a business. Don't lose your head. Don't jump into random positions. It's not a game. It's not a game. And for those of you, maybe because you get excited, if there's anything that defines retail traders, it's the whim to jump into multiple trades a day without any prior long-term examination. Sometimes out of excitement after a good trade, and other times out of sheer compulsion. I've had to go through this, and so I know it. And I had to write these things down and make a conscious effort to stop them. If I get a good trade, how many of you, after getting a good trade, you're like, well, that was a good one. I want to get on another one. That's one of the pitfalls. You're not going to go far like that. Random trades, jumping in on a whim. Such compulsive behavior is, if not controlled and mastered, will see you getting hurt real quick, and you're not going to go far. And this is one of the major setbacks to true progress for any trader out there. So you really need to deal with this. And the solution for me is limit your engagement to already planned assets. After walking through its price action in the last 20 to 40 days. So this takes us back to the very first rule. If it stops you out, then walk away. If you get stopped out, there's nothing else. Walk away. Come back another day. It's 1%. You decided what you were going to give to the market. It's 1% or 0.5%. Walk away. Tomorrow's another day. You're going to get a trade that gives you 5% and you cover up for that 1% or 0.5% that you lost. That's how to last. If you operate once a day, I think that's the classic way to operate. If you operate once a day, maybe during London or New York, then that should be it. Maybe it's 2 positions or 2 asset classes, then operate once a day. Take and use proper management. You get a little or 50 to maybe 25 to 30 or even 40 pip release in your direction. Absorb a volume or absorb a partial volume from that trade and let the others run. I've seen people wanting to get paid in full. That's what they call it. I get paid in full. I don't take partials. Well, I've seen a lot of times when traders who try to get paid in full don't get paid at all, because you can't know. You can't just know with a 100% certainty where price is going to terminate at. But when you get that release in your direction, 25 to 30 or even 40 pips, and for those of you who use really reasonable lots, like maybe 10 or even 15 lots, you would understand that that should be enough. If you compound that 3 times a week or 2 times a week, that's you make a living from that. Okay. And basically that's what I'm talking about when I make reference to this type of trading. It's for those who understand, because the goal should be to seek real funding. And so you should be trading for the money, not for fun. It's not, we don't do this for fun. We do this for the money, and it's a business. So limit your engagement on a daily basis. And the last thing, I hope you've been writing this down well. Even if you didn't, you have the video. These rules are very important. I challenge you to try them. The last thing here is to seek specialization. A very important marker of profitability in the market is specialization. I've seen traders who do not operate with that level of specialization. So what they do is they have 10 different pairs on their screens, and they jump on anyone they wish. And they do that on a whim. So the best way to get on track with consistency is to study and master the behavior of a handful of Forex pairs, if that's what you intend to do. Study their inverse/direct relationships on each other and the times to expect activity in these pairs. You must seek specialization, and you cannot do that trading 10 different pairs. I personally, if you have watched, you notice that I only trade a certain type or just a few Forex pairs out there, and I'm satisfied with that because they present me with a ton of opportunities every week. And sometimes it's even difficult for me to take advantage of every one of them because I miss them, and I'm okay with that. All of these things would give you peace of mind. So here I've got my own personal list, and we have the euro dollar, which you've seen me trade 100 multiple times. Dollar CAD, the Swissy, the dollar Swissy. I don't trade this so much, but I do when I do. But I've got this in my basket. So you've got the pound dollar, and then you've got the Aussie dollar and the Kiwi dollar. Now, there's a reason why I didn't list these two separately. It's because they always go together. They go together. They are directly related, or they have a direct relationship most of the time, 80 to 90% of the time. If you go check it now, you'd find that. And so when you understand if let's say we've got a bullish dollar, it means that all of these pairs that are paired to the dollar would be bearish, as you understand. So we understand the inverse relationship. And so when we expect bearishness in all of these pairs, foreign currencies paired against the dollar, then we know. So when you have Aussie against Aussie, the dollar, and Kiwi against the dollar, these two pairs have very similar behavior. That's the reason why I put them together. So if you work with this, I can almost guarantee you, and you follow these rules that I've put out here, I can almost guarantee you that you will start to see a change in your performance. I know that a lot of you who have seen others and you've seen the results of other people, you tend to jump into an asset class because it made Mr. A or B a millionaire and it did it quick. Well, if you really want to jump on a pair just because you had people or people who made a ton of money from it, then you might want to study it. Don't jump into trading it. A very good example is the US 30. I see a lot of folks trading that because it's really volatile and it promises them a lot of gain by using the smallest lot. And I understand that for those who want to use micro lots to make $1,000 or mini lots to make $1,000. I understand the feeling, but if you want to do this, then you might take at least 2 months to study that particular asset class. Yeah, you want to take 2 months at least. And that would bring me to my next and the last rule in my rule book in this presentation. So you want to take time to study that pair. You can't jump into it. The NASDAQ, the US 30, and some other pairs, and even gold, for those of you who are interested in gold, you honestly want to study it. And you want to study its inverse relationship. I use these because I realize that I don't need them, irrespective of the fact that they are very volatile. I realized that, well, this gives me 40 to 50 pips. I could do a whole lot with 40 pips. 40 pips, multiply that by 20 lots. I could do a whole lot with that because I'm better at this. Look for the pairs that you are better at and work with them. And that brings me to my last point, screen time. So like I said, if you think that a particular asset class would really make the difference for you, then you need screen time. You need at least 2 months of sitting down, not trading, but studying that pair, studying its behavior, back testing. There's no alternative to this rule. There's no alternative to it. If you must become comfortable and profitable in your daily operations, you must put in the screen time. This may involve back testing, price study, asset class study and the general time putting to familiarize yourself with the price action of a particular asset class. But you need the screen time. There's no alternative to this. So my advice would be at least 2.5 to 3 hours daily. But if you have other commitments that take a large part of your time, then the weekend would really suffice, and take the weekend to study and practice price action for yourself. And this one is the most important. If you've been trading over time, the truth is you have an advantage. If you've been if you've been trading for 3 years or 2 years, and you've been doing so, even with the losses and inconsistency, one thing is that you would now have a way of recognizing price action when you see it, know what to expect or what to anticipate. It's screen time. It's like going to law school or going to medical college or med school. You need the hours. You need to put in the hours to study. And that is the same thing here. You need screen time. It's like, this is like another type of university or another type of college. You need to study. And once you study it, all that time, years put into it, hours, hundreds or even thousands of hours put into it, is what is required for that 20-minute of price movement that gives you $20,000 in one swing. The preparation for a 20-minute trade or an hour worth of trading time, the years of preparation, or the thousands of hours or the hundreds of hours of preparation, screen time. There is no alternative for it or to it. And with this, I'm going to end this for today. You really want to put these down, and you really want to write them down. And if you operate on a daily basis, you'd really want to get comfortable and operate according to these rules. I can almost guarantee you, if you do these things, they have helped a lot of traders, and they have also helped me. If you use these things, you already know about the technicals. You already know these things. The truth is, even if you don't trade smart money concepts, but you apply these rules, it would really make a difference in your operations. And so this is the reason why I talk about this. And so that's going to be it for today. I'll talk to you some other time. And until then, have a good one.